Okay, so now we're going to start in on chapter 5. So we have been doing financial accounting. So chapters 3 and 4 were what we call financial accounting. Chapter 5 now, we're going to leave financial accounting and move into managerial accounting. So we're going from financial accounting to managerial accounting. Okay. And there are some important differences. And the main difference is the audience. Meaning, who are we doing this for? Who are we doing the accounting for? With financial accounting, I'm just going to abbreviate that FA. With financial accounting, we're talking to an external audience. So it's just a refresh, right? External audience. So that would be bankers, lenders, shareholders, other investors, right? Other kinds of creditors. So for example, maybe we have a relationship with a big supplier and they just want to know, can we trust you to issue you to sell you supplies on credit or not? Other stakeholders. So for not-for-profits, this would be the larger community, right? So a not-for-profit like a Wentworth Douglas or a Catholic Medical Center, right? They produce these financial statements for their board to review. Their board stands in as the interested parties for the community, right? They produce them. They produce those financial statements to show to their lenders, their bondholders, the banks that have loaned them money, and the broader community. You can get a hold of not-for-profit financial statements and review them yourselves. And I did a short video a couple classes ago using ones that I downloaded from Exeter Hospital. And I'll probably show you those again. Okay, so financial accounting is highly stylized, right? It is governed by generally accepted accounting principles, right? And all those things that we talked about back at the beginning of chapter 3, right? But it is, and then it is reviewed by an external auditor to make sure that, you are actually following procedures. If you don't, right, you as the CEO and CFO can wind up, being personally held liable. You can face, financial, you can face legal penalties for that. So because the financial accounting is used to communicate your health to the outside world. With managerial accounting, we now have an internal audience. And whereas financial accounting is governed by GAAP, right? Very specific, you've got to do it this way. No discussion, right? With managerial accounting, it's really kind of whatever works. Right? And I'm being a little bit silly with that phrasing, but it's not inaccurate. Managerial accounting, the purpose of managerial accounting is to provide guidance to managers, hence managerial accounting, managers within the organization so that they can make decisions about how to allocate resources within the organization and whether they are being effective within the organization. So the key is it's primarily focused at the sub-organization level. We are primarily interested in the operations within the organization, right, rather than the organization as a whole per se. We can use some of these techniques to look at the organization as a whole, but we're primarily starting to look at, so let's say we take, Catholic Medical Center, and we say, okay, Catholic Medical Center as a whole is going to be pretty well represented by the financial accounting stuff that we're doing. But Dr. Joe Pepe, the CEO of Catholic Medical Center, right, doesn't manage the whole organization on any given day. He's managing components of the organization, right? He's paying attention he's broadly paying attention to the health of the whole organization, but on any given day, he's worried about the mother and baby unit. He's worried about the vascular center. He's worried about the ORs. He's worried about all the components of the organization. And so managerial accounting starts to go down below the organization level and dig into the productivity and efficiency of the subordinate units. And so that's what we're really going to get focused on now for the next several chapters, or 5, 6, 7, the next 4 chapters are really kind of starting to dig down below the organization level and start to get at, okay, Taylor is the manager of the radiology, of the imaging department. How's Taylor doing in terms of managing her expenses? So we're gonna talk about we're gonna talk now about how to measure those kinds of things. And some of it's gonna look very similar, right? There's a reason why we start with the financial. Some of it's gonna look very similar, but we're gonna worry about some different. It's a different focus. So managerial is primarily around decision making. Right. And then there's a subsection of that called cost accounting, which gets into the costs, as the name implies, measured in a bunch of different ways. We're going to talk about fixed costs and variable costs, marginal costs, overhead costs, we're going to have a whole bunch of different ways to talk about cost. Right, so you're gonna have cost coming out your ears here pretty shortly. So let's start with that. So types of costs. So the ones that we're going to deal with in this chapter, types of costs. So first are fixed costs. So what is a fixed cost? Well, a fixed cost does not vary with the quantity of goods or services produced. So fixed costs do not vary with the quantity of goods and services produced. Okay, so let's think about a fixed cost. What are examples of fixed costs? So imagine you're running a clinic. What would not change depending on the number? So your clinic, so you're seeing patients. You have patients coming in, seeing your doctors and your nurse practitioners and your PAs. What's going to stay constant whether you do 1 visit or 1,000 visits? What cost?
The cost of running the facility, like opening it.
Cost of running the facility, like owning it? Okay, so can you think of an example of what that would be?
Like maybe the electric and stuff like that, like just running the facility.
Okay, so like utilities?
Yeah.
Okay, so electricity. Probably for a healthcare organization, your electricity is going to be pretty stable. I mean, you're going to turn on the lights, and so that's probably a good example, right? So if you're running just a outpatient clinic that doesn't have an enormous electrical draw, the electricity is going to be pretty much like turning on the lights, running the computers. There's not going to be a whole lot of variation in terms of your electric bill. So that's probably a good example. And I'm going to say right now, when we talk about fixed costs, we're talking about them within what's going to be called a relevant range. And we'll talk about that a little more in a minute. And so this is a good example. You know, you could come up with, like, you're probably sitting there thinking, well, sure, there's a way that we could drive up electric costs, right? Yes, and that's the case with all fixed costs. So we'll get to that in a second. Emma, you got one. So salaries, wages, and benefits, right? So can you think of a particular individual or a category of individuals that would be fixed? Housekeeping, okay? So housekeeping, probably a good example. Again, we're going to talk about it within a relevant range, but housekeeping is probably, you know, maintenance and facilities, okay? So, you know, so within a range, chances are you're going to have to do the same amount of taking trash out and things like that, right? So that's, okay. What other salaries? Yeah. PPE, fixed costs. So PPE meaning the physical equipment, right? And the rent that you pay on your facility would be is kind of a classic example of fixed costs. If I lease a building to put my clinic in, my landlord expects me to pay that rent every month, regardless of whether I did 1 patient or 10,000 patients. They'd be like, hey, the rent is due on the 1st. Give me my check. Give me my money. Right? So rent is a great example of a fixed cost, right? I think we said utilities. I'll say that, you know, kind of again within a relevant range. We've talked about some salaries. So I would go with, like, what's a salary? What's a person? So you think of a person who's operating in a clinic whose salary is not connected to volume at all. A secretary, perfect. Secretary. Maybe the practice manager, right? So you guys, right, going into the future. Right? So some salaries are definitely going to be fixed, right? The secretary says, hey, you pay me to show up for 40 hours a week. Not my problem if you can't get people to come see you, right? I expect to be paid my 40 hours. Same with mostly with nursing staff, though you could make an argument, and here's where, like, kind of you can start to say, well, no, nursing staff, sure, except that, you know, nursing staff is often, particularly at a hospital, nursing staff is often very flexible in the sense that if the census, meaning the number of patients in the building, is low, they will tell nurses to stay home and they won't pay them, right? So nursing staff, depending on what kind of organization and where you are, can be more or less fixed, right? Physician salaries are typically connected to volume to some degree. They've got like a fixed, they'll have a contract with a fixed dollar amount, and then they'll have a target number of RVUs, right? We talked about RVUs, so they'll have a target number of RVUs that they're supposed to generate over a year period of time, and their salary will be adjusted based on, you know, do they exceed those RVUs, in which case they'll probably get bonuses, or if they fail to hit those targets, they get a stern talking to. Those are employed physicians. If you're an independent practitioner, you, as the phrase is, you eat what you kill, right? So if you're a independent practitioner, you're running a one-woman practice out there, or a one-man practice out there, your pay is going to be directly tied to how many patients you can get to walk through the door, right? So it depends on who. So salaries could be fixed, but it kind of depends on who you're talking about, as well as kind of the scope. Emma. Right. Exactly. Perfect. Emma is right on target. She said, for those of you out there in Zoom, she said, if you have, how fixed is, say, a lease, a 3-year lease. After 3 years, you could change it, in which case it's kind of like not really fixed. So it depends on, so the time period is everything. In the long run, all costs are we'll get to it in a second, all costs are variable. So the other category of costs we're going to talk about today is variable costs. So in the long run, meaning long enough period of time, and what that means depends on the kind of asset you're talking about, right? So rent is variable in a period of multiple years. Sure, you can flex up and down in terms of your rent. But if you've got a lease for a year, you've got a fixed cost for a year. So if you're talking about a time frame of a year, you've got a fixed cost. End of discussion. You've got to pay that thing, like it or not. But if you're talking about a 10-year time frame, then leases can be looked at as variable. You can change them based on the volume you expect to do over the course of 10 years. Is long-term the life of the asset or in terms of the market? It would depend. That's a good question and an interesting way to phrase it. Right. I would say the way to look at it in terms of what's long-term, right, is whether you can change your arrangements or not. I think that's, the liquidity of the arrangement. So again, coming back to say a lease, right? If you've got a 1-year lease, you're locked in for that year. So that lease is not flexible. It is not variable in the year time frame. But if you go to a 5-year, if you have in your head a 5-year planning horizon, then that lease can become variable in the sense that we're going to change that based on the volumes that we predict are going to happen. Because we'll lease more space if we think we're going to grow, and we'll lease less space if we think we're going to shrink. So it really kind of depends on the planning cycle, the length of time that your planning cycle is, more than anything else, I would say. So, if you're on a 5-year or a 10-year planning cycle, things are going to look a lot more variable, meaning you can change them based on your volumes, than if you're on a 1-month planning cycle. If you're looking at things in terms of a month, well, rent is going to be fixed, end of discussion. The salary of your secretary is going to be fixed, end of discussion. Salary of your practice manager is going to be fixed, right? Whereas if you're on a 1-year or 5-year planning cycle, you can say, well, if we grow, we'll probably hire another secretary, or if we are going to shrink, we may cut our secretary to half-time. But I can't really do that tomorrow, right? I've got to have some planning window to do that. And so what we're getting into is the relevant range. So we've been talking about time, right? And in terms of time, in the long run, all costs are variable. So we'll talk about variable costs in a minute. But in the long run, all costs are variable. Now, the other point I want to make is this relevant range. So this relevant range is connected to volume, okay, or quantity. Volume or quantity. I'm going to use the words volume or quantity kind of interchangeably. In healthcare, we tend to talk about volume of visits rather than quantity of visits, so I tend to say volume, but really I mean more abstractly, I mean quantity, because this counts, these ideas apply to other than, say, providing a service. So relevant range, I want to talk about that. So we've kind of talked about, the idea that in the long run, all costs are variable. What about the relevant range? Let's imagine that you have an office space with 3 exam rooms, right? Well, let's say 6 exam rooms, right? one doctor needs 2 exam rooms to be efficient. Okay? So if one doctor can see, let me think, say 150 patients per week, and you are seeing, if you are seeing, and you are paying rent for these 6 exam rooms, for this building with 6 exam rooms, and one doc can see 150 patients per week, your fixed cost is going to be, I'm just going to make up a number, say $10,000 per month, right, in rent. We're going to ignore the other costs involved with this. We're just going to talk about the rent. Okay? So your practice is, if your practice is seeing 0 patients, what's your fixed cost going to be? 10,000, right? If your practice is seeing 150 patients per week, what's your fixed cost going to be? 10,000, right? If your practice is seeing 300 patients a week, what's going to happen? What are you going to need to do? You're going to have to hire a second doctor, right? So you start with one doc, you move. So actually, let's back up a second. Let's treat the doc's salary as a fixed cost. So cost. This is going to be cost. This is going to be volume, right? That's 150 patients. So we've got our first, if we're seeing, if we're seeing 150 patients a week, we're going to have fixed costs of 10,000, and then let me think for a sec, of 10,000 a month, and we'll have, say, we pay our doctors, just to make my math easy, we pay our doctors 20,000 per month. Okay, so this is rent, this is salary, right? So at zero patients, in order to open the clinic, we need a doctor and we need to pay our rent, right? So at 0 patients, we still have to pay the rent. So let's say the rent is 10,000, right? And so at 150, from 0 to 150, what is our rent expense? It's 10K. And then at 300, what's our rent expense? 10K. And all the way out to 450, what's our rent expense? 10K, right? Because within a relevant range, the relevant range in this case is going to be up to 450 visits per week. With that space, we can do up to 450 visits per week. What happens if we want to do 451 visits? And I'm being a little bit, like extreme here, because obviously we'd make room. But theoretically, what would we need to do if we want to go to 451? We need to rent another space, right? Let's imagine that in order to rent another space, we need to rent another 6 exam room space that's maybe next door. And its rent is $10,000, right? So to go from 450 to 451, right, we would jump up an additional 10,000 to 20,000 per month. So our cost is this dotted line, right, going along. From 0 to 150, it was 10,000. From 150 to 300, it was still 10,000. From 300 to 450, it was still 10,000, right? This becomes our relevant range for our rent. So anywhere between 0 and 450, our fixed cost for rent is going to be $10,000. But when we go to move from above 450, that relevant range ceases to be accurate, and we now move into a new relevant range with a new fixed cost of 20,000. Let's talk about the docs. The relevant range for doc number 1 is how much? 150 patients, right? So if we're seeing anywhere between 0 and 150 patients, we have to hire this doc and pay him $20,000. So our total fixed cost would be 30K, right? I'll draw a hard line there, because that's the 10K in rent plus the 20K in salary. When we get to 150, when we want to see the 151st patient, what do we have to do? We have to hire another doctor, right? We have a jump. I didn't draw this well, right? We have a jump when we hit 150. Our relevant range, that's the relevant range for the fixed cost for one doctor. When we hit 150, we're going to need a new asset, a second doctor, and our total cost is going to jump up to 50K now, right? 10 for the rent, 20 for the first doctor, 20 for the second doctor. So we're going to bump, this line is now going to be 50,000, and that's good. And so our fixed costs from 0 to 300, our fixed costs sorry, from 150 to 300, our fixed costs are going to be 50,000 per month. And then if we go past 300, we bump up again, right? And I realize that's not to scale, right? We bump up plus 20, right? Plus 20 again. So now we're running at 70K per month. So from 300 to 450, our fixed cost would be 70,000, right? So we see two different relevant ranges here. One for our rent. Our relevant range for the rent was 0 to 450. The relevant range for a physician salary was 0 to 150, right? So it depends on, your fixed costs depend on your relevant range. So the physician expense becomes variable, right? Or is variable in sort of a lumpy fashion. That's fancy finance talk. In sort of a lumpy fashion. It's called a semi-fixed cost. The point being that the cost is fixed within a relevant range. So doc salary is fixed within a relevant range. Now, if you said, hey, we want to have a relevant range of 0 to 450, then you would have to hire 3 docs out of the gate, right? If you wanted to have a 0 to 450 relevant range, you would have to hire 3 docs out of the gate. And if you weren't hitting the somewhere between 300 and 450, you'd be wasting an awful lot of money, right? Which is kind of one of the questions that we ask. This is the kind of thinking that we want to get into in managerial accounting, is we've got to have these, if we want to have these assets, like we want to have the capability of flexing up to 450, well, what are our costs going to be? Well, they're going to be, if you want a relevant range of 450, you're going to have fixed costs of $70,000 over that range. If you want your relevant range to be 150, then you're going to 0 to 150, and your relevant range is going to be 100. Then your fixed costs are going to be 30,000, right? So depending on what you decide, your planning range is going to be. And this is, I'm making this more complicated than I probably should in an introductory discussion. But you have semi-fixed costs and you have truly fixed costs. Focus especially on this idea that there is a relevant range, and when you exceed that relevant range, your fixed costs jump, okay? And they either become semi-fixed costs or truly variable, and that kind of truly variable depends on, again, back more on your time frame. Emma. Yes. Yeah, so yes, so fixed cost, so relevant range is more about volume than it is about time. Defining what a variable cost is versus a fixed cost, theoretically, everything is variable given a long enough time frame. There's a famous economist named John Maynard Keynes that says, in the long run, we're all dead, so it doesn't really matter. But, you know, but in the kind of, in these terms, right, in the long run, all costs are variable, okay? So time has an impact on whether a cost is variable or fixed. Relevant range determines whether a fixed cost is truly fixed or whether we're going to have to add cost to a calculation, or whether it's kind of semi-fixed, if you will. So for our clinic, if you're looking truly at rent, the relevant range is 0 to 450. For our clinic, if you're looking at physician costs, the relevant range is 0 to 150. So it depends on the asset as to whether it's fixed or not, because the asset's going to have different relevant ranges. They're going to have different capacities, if you will. So a lot of times you will talk about this when you get into the field, talk about assets that have excess capacity, practices that maybe have excess capacity, right? That you're paying fixed costs on and they're not performing up to the maximum, right? So if we were looking at this practice as a 0 to 450 arrangement, we would be paying $70,000 in fixed costs per month. And so if we were doing, say, 350 visits, we would as managers say, we've got a lot of excess capacity here. We've got a doc who's not fully employed, who's like hanging out, doing a lot of time on Facebook, right, instead of seeing patients. So we've got excess capacity. How are we going to push that asset all the way up to its maximum capacity? So that is one of the goals of managerial accounting, is to squeeze out all the excess capacity, because otherwise it's wasted money, right? Al, you had a question.
For the salary, we
because you're paying the doctor a monthly salary. Let's assume the doctor is totally on salary, doesn't get any variance based on how many patients she sees. You're just saying, this is an employment arrangement. Docs show up, we'll pay you. So a lot of ED docs, for example, get paid by the shift. Emergency department docs get paid by the shift. And if they come in for a shift and nobody shows up to get treatment, or if somebody with a sore throat shows up to get treatment, and that's it, then they get off easy. They still get their, however much money they make per shift, $2,000, whatever it is per shift. If they show up and there's a 20-car pileup, and somebody's giving birth in the other room, and like what you see when you watch hospital dramas on TV, then they still get their $2,000, right? And so it doesn't. So their salary is a fixed cost. It doesn't matter how many patients they wind up seeing. Does that make sense? Right. Exactly. It's an additional doctor. So from 0 to 150 is one doctor. So we're paying $20,000 in doc expenses, right? When we bump up from 150 to 300, we have to hire a second doctor. So this is 1, this is 2, right? And then this is 3 docs. Now the problem we run into is we only have room for 3 docs in our clinic. So if we want to expand past 450 patients, we have to blow out a wall and buy more space or rent more space. Yep. All right. Okay. So relevant range is really important, and this is kind of an illustration of that. So the doc piece is sort of an example of semi-fixed costs, right? Where the fixed cost jumps at a certain level because you've gone outside the relevant range. And there are other factors that could affect, the relevant range is more complicated than that, because even as this simple example demonstrates, an organization, whether it's a clinic or a hospital, has multiple assets with different relevant ranges, all being kind of lumped together. If we're trying to look at at an organization as a whole or a department as a whole, there are multiple things in there. So you're kind of, in the real world, you're kind of, you're estimating, right? You're kind of mixing a lot of stuff together. But for our exercise, we're going to try to be as discrete as possible. All right, so that's fixed costs. The other cost that we're going to focus on is variable costs. We've been kind of talking about them already. Feels like they're old friends. So variable costs. Variable costs vary with volume. So they are directly related for our exercises. They will be directly connected to additional volume. So what can you imagine would be an expense in our clinic that would go up every time you see one more patient? Supplies, gloves. Sorry? Band-Aids, sure. Right? I mean, depending on the appointment that comes through, there's going to be some mix of supplies, right? But on average, we're going to have this average amount of supply use per visit. Right, so gloves and the paper that they pull down on the exam table and all that kind of stuff, right, goes up every time you see a patient. You're going to work out an average, like a month, you'll look at an average supply expenditure over a month and be like, all right, on average, we spend, $10 per visit in supply expenses. And some are going to be 20, some are going to be 5, but on average, we're going to come up with an average variable cost per month. Right? Or per week, or per day, or whatever the appropriate time frame is, and you got to be flexible with that with these examples. So I will give you the relevant time frame for any problem. I'm not going to make you dream it up, right? So for any of our problems. So, for example, if you've got a flu clinic, right? That's coming up anytime now, right? So for a flu clinic, you would have, and this is a short-term asset, so you're gonna have a nurse, right? Nurses' hours. You're gonna have vaccines. You're gonna have syringes, needles, Band-Aids, right? And maybe some other things, lollipops for the kids, whatever, whatever else you're going to have. But those would clearly vary with the volume that you're doing. So, every time you give a shot, you're going to use up a needle, you're going to use up a syringe, you're going to use up a dose of vaccine, and you're going to use up a Band-Aid, right? So that's going to be, so that's a pretty clean tie directly to, every unit that you do. And nurse salary is a little more lumpy. Maybe I'll take that. Yeah, everybody's crossing it out. Okay. Nurse salary would be a little more flexible, a little more fungible. But you would have, your nurse salary would be pretty much directly tied. Now you could imagine that the nurse has a fixed salary at the organization level, right? So maybe the nurse hangs out, normally hangs out in the family practice clinic, but he's being allocated to the flu clinic for some X number of hours, right? The number of hours that get charged to the flu clinic and not charged to the family practice clinic would vary depending on the volume, because the nurse would go back to the family practice clinic when he's done all the vaccines, right? So there would be something variable there, but these are probably cleaner, simpler ways of, more direct way of measuring. So that's better example. Cross that out. Okay. Whereas, say, maybe the space that you're doing the clinic in would be a fixed cost, right? Lab tests are another good example of this. So we'll mix together lab tests. So my father is a retired pathologist, which is a laboratory medicine guy. Right? So he was the medical director for the laboratory out at Cheshire Medical Center of Keene for almost 30 years. So he's a physician, physician trained in laboratory medicine. So I remember when I first started teaching this class, I was talking with him about some examples that relate to this. So one example would be, they run some tests and I guess I would count a biopsy as a test. They run some tests at very high volumes, right? So if you get you go in and they're like, I'm going to draw some blood from you, collect some urine, right? Those all go into these little tubes, right? The tubes get sent over to the lab. Lab tech takes the tubes and drops them into a machine with 100 other tubes and hits a button, and the machine does all the work, right? As opposed to, there are some tests where you get a punch biopsy, for example. You go in, you've got some sort of coloration in your skin. Your family practice doc takes a little widget of it out and sends it to the lab, right? Well, when they send it to the lab, it goes to the pathologist who makes the psychologist probably makes a slide for the pathologist. The pathologist looks at it under a microscope and says, that is or is not cancerous, right? So one example, the first example where we're getting loads of test tubes, and they're basically just being dropped into a machine and run, right, is an example where you have a fairly high fixed cost. What would the fixed cost be? No, not the vials. The machine, right? So the machine that runs the tests, because the vials, they're directly connected to how many tests you do, right? So the variable costs would be the vials, depending on whether you want to count the phlebotomist needles. Go ahead, Emma. No. Right. Because your cotton balls, you're going to buy more cotton balls with more patients, fewer cotton balls with fewer patients, right? It's directly connected to the number of patients that get a test. Quest Labs is not going to order 1,000 cotton balls if it's only using 500 of them, right? So cotton balls is an example of a supply. Typically, supplies are variable because you only order enough to do what you're doing, right? Whereas for Quest Labs, the building where the lab is, that's a fixed cost. All the big equipment that they have in the back to run all these high-speed tests, those are fixed costs. The personnel are fixed costs, right? The technicians are mostly fixed costs. But then you'd have the vials, the syringes, the needles. There's a thing called reagents for those of you maybe that are in chemistry or biology, right? The reagents are the chemicals that get used to run the tests, right? So those are variable, right? How much reagent you need depends on how many tests you do. So there's a direct connection between the number of vials, the number of reagents, and there's a bunch of other costs involved that are directly connected to the volume of the test that you're doing. So you'd have a machine that has a fixed cost, and then vials that would have, and reagents and other supplies that are used kind of on a one-to-one ratio with how many tests you do, right? So let's run with that. We'll run with that in a minute. So what we're trying to get at is the underlying cost structure Right? Underlying cost structure is basically the pattern of fixed and variable costs, right? That contribute to the overall total cost. So you've got some total cost, and what you're trying to get at is you're trying to break down the total cost into two components. What portion of my cost is fixed, and what portion of my cost is variable? And so the cost structure, I'm going to refer to the cost structure for running a test in a lab. Like, let's talk about this for a minute. Let's assume that they lease the equipment for $50,000 per year. They pay a lab tech $50,000 per year. And they have $10 per test in reagents and other supplies. And let's say that over the course of an 8-hour shift, one tech, one machine can do no more than 20,000 tests over the course of a year. So it's a lot of tests over the course of a year. So a tech working 8 hours a day, 5 days a week for 52 weeks can do 20,000 tests. So what does that tell us about our relevant range? Right. So our relevant range in this case is 20,000. So we can go anywhere from 0 to 20,000. And what would our fixed cost be? Fixed cost. 100K, right? Why? The equipment and the lab tech represent the fixed cost for this operation. The lab tech is not on a, he or she is not working on a commission basis, right? She shows up in the morning, hangs up her jacket, puts on her little white coat, right, and goes into the lab and starts taking the samples and putting them in the machine and flips the machine on, goes and gets the next set batch of tests ready, takes out the old tests, puts them back in. End of the day, she takes off her little white coat, hangs it up, puts on her jacket, goes home. Right? He expects to be paid her $50,000 a year. And she doesn't really care. I mean, maybe she probably cares to some degree, but she doesn't really care if it's 10,000 tests, 1,000 tests, or 20,000 tests. She's going to come in and she's going to work 8 hours a day, 5 days a week, right? Put on the coat, run the test, take the coat off, go home. Right? So from her perspective, it's irrelevant. The machine also does not care, right? The company that is leasing you the equipment does not care, as long as you pay the $50,000 a year. The company that's leasing you equipment doesn't care whether you're running it 0 times or 20,000 times. They want their $50,000 a year. So good point. Okay, so Emma asked, if you lease, is there no depreciation expense? The answer is no. There is no depreciation expense because you don't own it. You do have a lease expense or rent, right? Either. There totally could be. So that depends on the lease arrangement. It could be that the company that leases you the equipment does in fact care if you run it more than 20,000 per. If you somehow ran the machine 30,000, they may be like, hey, you know what? You're putting more wear on our machine than we agreed to. Therefore, you owe us a higher rate. So good point. The flip side of that would be if it wasn't a lease, if we bought the machine for $300,000, right? We would, and it had a 6-year life, just to make it convenient, right? $300,000 purchase price, right? 6-year life would give us a depreciation expense of $50,000 per year. So when we purchased the equipment, it would show up where? Which statement? First. The day we buy the equipment, where does it show up? Which financial statement does it show up on? The balance sheet. Where? Assets, good. Where in assets? Long-term assets, good. Which one? Property, plant, and equipment, right? So it's going to go in that gross property, plant, and equipment line is going to go up by $300,000, right? And then we're going to use it this year. And it's got a 6-year life, so 300 divided by 6 gives us 50,000 in depreciation expense. So at the end of the year, 50,000 in expenses, in depreciation expense, goes onto the income statement as an expense, right? And on the balance sheet as what? It's not a liability. It goes onto the asset side under accumulated depreciation, right? And it reduces the gross property, plant, and equipment by $50,000. So at the end of year 1, we're going to have a gross PPE equal to 300 if there's nothing else there, right? Accumulated depreciation of 50 for a net PPE of 250, right? And on the income statement, expenses would have gone up by 50,000. So we would be indifferent from a, well, there are reasons why we might not be indifferent, but from an expense perspective, right, buying it for 300,000 and taking $50,000 a year in depreciation expense from an income statement perspective is the same as leasing it for $50,000. Now, the downside there would be, or the other perspective of that is on a lease, if I lease that equipment, it doesn't show up on my balance sheet. Right? It's not on my balance sheet. It's not mine, so it doesn't go on my balance sheet. And so I've got an asset that I have access to that is not on my balance sheet. So my balance sheet is, I really have, if I'm leasing, I really have access to a thing that's worth $300,000, but it's not on my balance sheet. Airlines do this, by the way. Airlines lease their planes, right? And I mean, there's some variation here, but there are, well, not planes. I think actually that might not be true. I need to check that. There are organizations that are able to lease things and they don't show up on the balance sheet, but they have these assets, capital asset versus operating asset, capital lease versus operating lease. We'll get into that next semester. If you have an operating lease, it doesn't show up. So this example would be probably, well, would not be would be an example of an operating lease. Doesn't show up on the balance sheet. So you have what's called off-balance sheet financing, basically, which means that your organization has access to these assets, but it's not reporting them, and so it looks like you have less stuff than you're reporting. More detail than you need right now, but I just want to connect us back to chapter 3 and 4. Okay, but for now, so for our exercise today, the fixed costs are going to be the lease and the lab tech. If we owned the equipment, the fixed cost would be the depreciation expense. Okay. So as we start to build our underlying cost structure, let me keep that here for a second. So our underlying cost structure, or our total cost, I'm going to abbreviate total cost as TC, is going to equal our fixed costs plus our variable costs times the quantity produced, right? So what you guys told me a minute ago was, if they do 0 tests, right? They've leased the equipment, they've hired the tech. If they do 0 tests, they still have $100,000 in fixed costs, right? So if you buy the equipment or lease the equipment and you hire the tech and you do 0 tests, the tech comes in, hangs up her coat, puts on her little white lab coat, goes in and sits next to the machine and waits, right? You still pay $100,000 a year. If you do 1 test, right, you have a variable cost, which we said was how much? 10, right? Times however many tests she runs. So that is the underlying cost structure. Total cost equals fixed cost plus variable cost times quantity. Sometimes I write it variable cost times volume. I'm going to switch to quantity because there's too many V's. If I do VC times V, I think that gets people confused. So I'm going to try to say, if I say VC times V, just remember I'm old and I forgot. So VC times Q, right, for variable cost per unit times quantity. Okay, so that gives us our underlying cost structure. And I'm out of time. All right, so we'll pick up next time.
Professor Bonica, can I ask you 2 quick questions about the exam?
Yeah, go ahead while I'm hanging up.
Okay. So is it on chapters 1 through 5?